But in true promotion fashion, I'm cramming last night, cramming this morning. I'm way too prepared for today.
You ready to go?
We're going to spice things up a little bit today.
Okay.
And also, I outdressed you today. So let the scoreboard reflect. We ready to roll?
Welcome back to Market Insights, Wednesday, July 15th, joined by new co-host, Dan Goeddel. Dan, what are you hoping to bring to the podcast?
Chris, I can't believe you gave me a promotion, first of all. I'm thrilled. I over-prepared last night. I wore a tie-it-out classy today. But in all seriousness, I am a Market Insights super fan. So I was in the room when we cooked up this original idea. So it was March of 2020. Everybody's in lockdown. It was me, John, and Aaron in the office. And the idea behind Market Insights was we have no way to talk to our clients right now other than phone calls. Let's speak with one voice as a firm. We say firm to family. Let's actually speak with one voice. Let's have it straight from our chief investment officer, which was Aaron Tuttle at the time. And let's tell them what we're really thinking. I mean, most clients are working with a firm where you turn over your whole life savings in your account, and it's like a black box. You have no idea what they're thinking, what they're trading on markets, and everything you get is like this compliant, stripped down, safe version that sounds the same, right? The roller coaster. But Market Insights, Aaron made a bold prediction of a V-shaped recovery in COVID. And we actually tried to take a unique stance that you won't hear on CNBC. And I think I want to bring a little fun and entertainment. I tried to do that when you brought me on as a guest, and hopefully the clients want to send me emails and questions to kind of even further bring this out. But I think the magic of Gatewood is in the halls, and we talk markets constantly. Like, we have so much fun, and I want clients to kind of hear that inside baseball and banter.
My favorite from the COVID era was, maybe we can throw a clip of it, Aaron and John filming in our lobby. And we just had signs up in the hallway, filming is occurring, be quiet, so no one.
Well, they literally had a chair, and on top of it, they had all Aaron's, investment and economic textbooks, and they had a little iPhone barely holding on by a thread filming them, and they were just two guys sitting in a lobby talking. Go back to our first episode 1. We're on episode what number now?
We're gonna go with 167. We haven't counted that once.
167?
I've done about 110 of them because I wasn't on it for the first full year. And with this, you're at 5 now, so this is good. The other thing you said you wanted to bring was hit some headlines that maybe we don't necessarily hit, and accountability to past calls month over month. So I think that's how we'll probably start every call going forward.
I think that's a good idea. There are fun headlines, then there's like headlines that really matter to the whole year, like a few themes. But what drives me crazy when I'm watching CNBC is you have all these market strategists come out and make, they get out their crystal balls, they make all sorts of predictions, and there's no accountability. And it drives me nuts. So I think one thing the viewers should expect from us is a little accountability. And it'll be fun to go through. Last month, we had some wins, we had some losses. It'll be fun to go through our scorecard. The big idea from today's Market Insights episode is to fund your cash account and take profits right now. If you have not done so, go to gatewoodwealth.com, and one of our advisors will be able to help you get that set up. Lastly, smash the like button, and I'll be back next month. I'm going to start with the fun headlines. And the first one was the World Cup in the U.S. actually showed up in our economic data. We've been kind of struggling. We're netting, jobs created and lost have kind of been flat. We're going to get a little bump from the World Cup. The hot dog and beer vendors really came through for the economy this month.
It brings us to the silly part where we all know this. It's going to hit the data. But people still get a little frustrated when a good jobs number comes up and interest rates go up and markets go down. We had a huge sell-off like about a month ago when that happened. The market should know this. It's one of those weird things that the market's pretty efficient, but it can make some mistakes.
And Chris, have you been watching any World Cup? You're a big soccer guy, right?
I am not a big soccer guy. Thanks for calling me out. Big America guy, Patriot. We will talk about that in the next slide.
It's kind of fun. Every 4 years this comes around, and I'm a soccer fan. But I see people like Chris who he's not going to even watch a single game. Let's be real, Chris. And then you have people like my dad. I love my dad. It has become his whole personality. And I think there's a hilarious range. I'm somewhere in the middle there. I'm going to be sad when it's over. But I think the U.S. team did a really good job, and I'm grateful they're, contributing to our jobs number.
We're spending way too much time on the World Cup. These are growing pains with a new host. I promise you, I will fix this over time. Next headline you had was the president telling Walmart, hey, good job for lowering prices. That's something, the Walmart prices you're not going to see hit the headlines, but we did get inflation report yesterday. It was fantastic.
It was a new one for President Trump, announcing price cuts before the company themselves announces it. Trump has used that bully pulpit in some very new and unorthodox ways. And that was one of the stranger ones for America's 250th.
It's always good to see a retailer with notoriously low margins get announced they're going to lower their prices. I want to show some real data because it works well here, which is inflation report yesterday. Month-over-month inflation down 0.4. You can annualize that out. That's just a monthly number. It's only expected to be basically flat, down 0.1. Big beat, just supportive of markets. It takes, we'll talk a lot about the Fed later, but the market is really thinking the Fed's going to raise interest rates. And we've been saying for a while, they don't need to. They're in a perfect spot to just stay here. This was an inflation number that shows, just stay here. You don't need to raise rates. It shows a lot of things that all this Fed speak that's been going on, saying, hey, we need to raise rates. And you have the Fed chair saying, I don't like all this Fed talk. It shows exactly why, because now you get new data that shows inflation. I think we'll see the high of inflation. I think we saw peak inflation last month. You can hold me accountable to that one going forward. So that would be above what we ended up getting, the 3.5 year over year. A lot better than what the market was expecting. Should be supportive in the short term, at least for markets.
I think so. And you made a bold call at the beginning of the year, which is 1 or 2 Fed cuts this year. So I think this data supports that. But we're halfway through the year. There's a lot of game to be played,
And the new information was, of course, the war. You did have to take that off to then saying they're not going to cut rates anytime soon, because I think they will for productivity reasons going forward. But because of the war, we pulled that back and said no cuts. And the market's expecting hikes. So just going from expectations of hikes to nothing, no cuts, nothing, that's supportive of markets. And I think that's the backdrop we have the rest of the year.
Are you staying strong on 1 or 2 cuts this year?
No, I've changed it. You still don't watch the show. We've changed that. We've changed that call because of the war. We brought it back to 0. We had one more headline you wanted to hit.
Oh, this is a fun one. So Chris and I joke about good and bad omens for bull and bear markets. I sent him a picture of my kids wearing a towel that's a little bear, towel. And he said, that's a bad omen, except my daughter did fall that day and she had a busted lip. And he said, well, the Bears are looking pretty beat up. So here's a bad omen, I think, Chris. It's AOL is public again. One of the darlings of the .com bubble and bust is back on the market. If you really want to trade that position, go for it. I won't be participating.
Good. I'm going to avoid that headline too and just go back into our accountability. I said earlier, we're patriots. We support America. We know how difficult the diplomacy has been with negotiating in the Iran war. Mm-hmm. We may not have said it, but everyone knows that. The market knows that. And so I would compare what's been happening with more escalations a lot like what we saw with tariffs. The initial tariff hit, market goes down 20-25%, recovers last year. And of course, there were more bad headlines for tariffs going forward. The market learned to work through it, and those became smaller events, and significantly smaller, talking 2, 3, 4, 5% pullbacks, but not the 20% pullback.
I think most Americans don't even know if the war is on or off or where it's at with the headlines and the whipsaw. I think the market's totally going to look past this. But, I think it's a little bit exhausting to try to keep up with this. It's like war on, war off. And the military victory has been, absolute. It's been complete dominance on the battlefield. But the diplomatic victory, I don't even know if it's achievable or defined. I think they've kind of said, hey, if Iran can never get a nuclear weapon, that's the diplomatic victory.
It's changing, right?
But how you achieve that, I think, is unknown. They say, can we go in and get the material? Can we, quote unquote, mow the grass and just hit the site if they ever try to rebuild?
That's what the market will be ready for. Everyone's expecting that. And going back to also what the market should expect, and if we went back to our original calls on this, we said if oil's in the 80 to 90 range, everything's fine. Market can handle it. Consumers can handle it. We produce a lot more energy here, and our economy is a lot less energy dependent than it used to be. Both of those are good things.
Well, And I think the U.S. Energy market's going to benefit. Right now, 20% of the oil flows through an area that's basically like from the St. Louis Arch to where I live in Chesterfield. It's crazy. Like, it's a total choke point. It's been vulnerable for a long time. It's kind of crazy this hasn't happened until now.
Yeah.
So I think the global flow of oil is going to diversify, and U.S. is probably one of the beneficiaries of that.
And right now we're in the low 80s on WTI oil prices. Again, that's fine.
Yeah. I do think it's a horrible headline for Trump going into midterms. I think I was just starting to feel the relief at the pump, over the last 2 weeks. And is that going to go away again? I think that can be, demoralizing to the consumer. In our economy, it's 70% consumer.
Part of the energy at the pumps too, going back to what Trump was, I remember he was tweeting at the gas station saying, you lower your prices, oil's down a lot more. We're in peak drive season. We're in peak demand. You could see energy stay flat, and on that CPI report, which is seasonally adjusted, because you have to adjust based on demand of past times, so you got to adjust for holiday seasons as well. You could see that'd be flat, but have a negative number show up, which is a good sign. Yep. And that's what he didn't really understand was happening, as we're seeing prices trickle down. Now they're not falling down, but they will over time if we can get past this. And I think that's the base case. We're going to get past this. One spot we nailed was SpaceX.
We did nail this one. Yeah. Although I don't know if it was like a contrarian take. I feel like the best people in the market kind of said something similar to us, but we did nail it.
We thought we'd see a big rally up, which we did. IPO priced in the 130s, rallied over 200. We even threw up a chart that said, here's the biggest drawdowns of the last IPOs. They typically go 20 to 40% down, and you might not even notice it. Well, SpaceX did that already.
Aren't we almost exactly 40% down?
From its intraday, if you count that. Those charts wouldn't. So it'd be about 30.
Yep.
So it got a 30% drawdown back to the IPO price. I said originally I kind of liked the IPO price, but I didn't like the market price, which would be that price that runs up past 200. So I'm taking my view and I'm changing it. I'm more neutral on it now. It's now we still have the float coming on the market over the next year, which is going to be a lot, meaning every quarter, month, there's going to be new insiders, former investors that can sell. It's big supply hang, which I do think will lead to some difficulties for the stock, but it's now gotten past that original IPO. It's a stock now. It's a business. It can report its earnings. It can report its TAM, how it's doing on those big numbers. If they improve towards those, and the way we wanted to play this, and I mean, the hype that we saw just from other people calling in here talking about it, we wanted to play it through the exchanges. We bought Robinhood in our stock strategy.
Well, we're going to end today's call with a really cool company spotlight on Robinhood and that play specifically.
Please, compliance, let us keep that in there.
Please, compliance. You're our only hope.
We want to talk about it. We didn't want to play the stock, specifically SpaceX, again, not a big view on its cash flows, but we had a view on what Robinhood could do based on this increased activity. We'll talk about it. We're entering earnings season. We've only had 2 days of it now. Yesterday, great kickoff for earnings season. The banks always started off. It was, for our portfolios, most exposure is JP Morgan, Goldman Sachs. Both of them, great numbers. We have a chart here that's going through our EPS beat rate. We added Bank of America, Citi, and Wells Fargo, not in the portfolio, but still showing the broader participation of the space. And then averages on the far right. The banks had a great numbers. And my favorite thing from the reports, just how quickly these headlines move. Last quarter when we did this, me and Aaron, we're talking about private credit because that was all the banks were talking about. Yeah. We have pulled back the discussion of private credit at the bank level. I'm not saying we're past it.
What was the main thing they talked about on their earnings calls?
It was broad-based. It was loan growth. It was through their net interest income was good. And obviously, the investment banking divisions did great with SpaceX, some more issuance on bonds. There was a lot of good activity going on there. And the market knows that's one-time-ish and that there will be more activity.
So what's your prediction for overall earnings season? So last quarter, it was one of the best we've seen in our careers. Do you think we've got that on deck again?
I do. The hard part is predicting the reaction on these mega caps. So Microsoft's been a long-term portfolio holding in our mode strategy. We've tracked it. The cash flows have looked great. Obviously, they're spending a lot of money to build out data centers. We've moved past this headline of what's going to drive the stock over the next month. I don't know. It's a long-term view, but they could cut guidance on spend. The stock could go up 10%, or it could go down. It depends on really how the market's feeling that day. I would want them to see cut back a little bit of the spend, and I would think that the market would reward that. But other companies have done that, and it hasn't necessarily happened. So a long way of saying, I think earnings are going to be great, but as far as the forecasts go for spending, I'm not sure how the market will digest that.
What's the one earnings call you're most looking forward to
I think it's Microsoft.
Microsoft is number one?
It hits all of it. It hits the AI spend, which on building out the infrastructure, so the hardware, and they're still a big chunk of their business is seat-based subscriptions into software. So that company gives us a look through and all of that.
Yeah. I'm most excited for SpaceX. No surprise to the audience. I think it'll be fun to see how they approach it. I think Tesla approaches earnings calls a little bit differently in their unique way. And I'm curious to see what Elon does with the first SpaceX call. So, Chris, we're halfway through the year. Give us a quick update on the major market indices and where they stand. And the broader question I'm getting from clients is diversification actually working now? Because it seems like it is.
It's working partially. So from the global standpoint, you got this great return from emerging markets. It's the second asset class here on the chart. We can throw it up here. Small cap was number one, something we've been calling for 2 years. So we made the prediction in 25 and then again this year. So we've been right this year, wrong last year. Does that count as
you were
anything?
Early can be wrong, but you're right now. So we'll give it to you.
The problem with emerging markets been great. Diversification, extremely volatile, and it is become the AI trade. It's Korean stocks that are making semiconductors, designing semiconductors, a combination of that entire space, the memory space. So it's kind of the same trade that's showing up in the S&P 500. So just looking at it from a diversification standpoint, it provided some, but it's the same trade.
Yeah.
Small cap's different. There's not a lot of AI happening in there. Use cases, productivity cases. I think what we just saw was entering the year, they were just sold off a lot, haven't appreciated a lot with the rest of the market. There's a big catch-up trade that they could benefit from. And that's what we've been calling for a while. We finally did see it so far this year. I think it continues.
So broadening out. And so my prediction for the year is not looking good right now. It was that the Mag 7 was going to continue to lead markets.
You got lucky. So you said Mag 7, but your pick to do the trade was the NASDAQ 100, which is full of semiconductors, Intel, Micron, which have all pushed that up. So your call that Mag 7 would perform was wrong, but your vehicle that you chose was right because the NASDAQ 100 is up 15%.
There's a reason 16%. I'm not on the investment committee and you are, Chris.
So it was a good call.
So, Chris, one thing I try to bring perspective to is we are in a longer-term bull market. If you go back to ChatGPT's launch at the end of 2022, the market is up and to the right aggressively. It's a cumulative rate of return for the S&P 500 of about 85%. So annualized rate of return is what, Chris? 18%. That's phenomenal for the S&P 500. We've been spoiled rotten. Now it's come at a cost. So the cost has been, the average drawdown in every single year has been a market correction. There's been plenty of opportunities to panic. But I don't know about you, but in order to have fun, you oftentimes have to pay a cover charge. So we're both SLU boys. So what was your favorite part, SLU, Chris?
No. Cut.
I found my border.
Markets have been great. Lots of pullbacks. And that leads us to what we do when that happens. Not making a huge market call. It's our cash hub strategy. Bear with me. I'm giving a presentation on this next week, so I want to practice it. Bottom right of this chart, yellow line, S&P 500, you referenced it going back to COVID. Now, we haven't figured it out perfectly on how to show this because the drawdowns don't look extreme because we've moved so much over the last 6-7 years, but those pullbacks are big. There's a 30% pullback on the far left of the chart. And the blue lines, the blue circles, are us adding cash. And the blue line is our cash monthly target. So every time we see a blue circle, you're going to see that increase in our hub target. And then stair step down just means we spent down cash. That's the goal of the strategy. Build up cash when things are going great. Spend it down, see those stair step down. Proud of the 2022 moment. The market was down for the full year, down over 20%, and we had plenty of cash, and we just saw the stair step down. No one had to panic. None of our clients did. They all stayed invested. We had 2 clients in COVID who sold out of our client base. That's great to only have 2. We had 0 in 2022 panic because of this, which is fantastic job by our advisors.
It really helps you not to panic when you have a cash cushion and you've got kind of that first layer of defense. And this is a service we do at no additional cost to clients, and no other firm has been able to replicate this yet. So Chris and his team, they set policy the first week of every quarter, and they say how many months worth of a client's spending off their portfolio should they have set aside in cash, right? So we got back to our baseline of 24 months. So all of our clients, if we had a bear market start tomorrow, we got 2 years of cash, and ideally we have 5 to 8 years of bonds, depending on client preference.
Which takes that risk, because the risk everyone has right now, AI overbuild.
Yep.
Some bubble that blows up, and those bubbles can take years.
Yeah, I mean, you have dot-com bubble. It took 8 years to hit a fresh market high where you'd want to sell your stocks again. Great financial crisis was 6. So, for clients that are approaching retirement or in retirement, we want to use the good times to prepare for the bad. That's what real risk management is. So the conversations, all of our clients are having with their teams this week is, we're going to get you back to 24 months of cash. When you add in bonds, this is your total safety. You're ready for the next big one. And yes, we've had bear markets and market corrections frequently, but they've all been quick recoveries. We haven't had a really big one where you add the economic recession, where it's going to take years to come back. And our clients are ready, and I'm proud of that.
A new one I heard this time around was when they're making the calls and saying, hey, we're putting cash aside. I heard from a couple of people that said the client got a little concerned that, hey, you're taking chips off the table if there's an imminent pullback. Typically there has been, if you look back at our chart, we've done this pretty well. I want to be wrong on that. I'm not forecasting a pullback. It was really just to get back to that baseline. There's risk in the market. We talked about one with Iran, and we have the midterm elections. There's a lot that's going on. Just want to get back to the baseline. It's not a market call.
Yeah, and we want all of our clients to be positioned where they don't have to watch CNBC and panic and check their Apple stocks app. Like, we want them to be present, enjoying their life, and more importantly, not have to cut their spending if that bear market happens. So our clients are ready. It's a huge collaboration between our advisors, our operations team, and our investment committee, but we got it done yet again. I'm proud of it.
Let's move to something I just got funded last week, my Trump account for my 1-year-old.
That's amazing.
Yeah.
I'm so excited about Trump accounts. What I've been telling everybody is I don't like Trump accounts. I love them. They are absolutely incredible vehicles. Like, when you think about Social Security, if you take a client, when they retire, you look at everything they put into Social Security, okay? And you model out everything they're going to get paid out on the back end in retirement. It is absolute theft. And if you were invested in the S&P 500, like the Trump accounts say you have to be, clients would have like 2 to 3x, I haven't run the models recently, what they get in Social Security. So for the upcoming wave of young Americans, this is probably the antidote to Social Security breaking in the future. I think this is the policy piece we've been needing, and it unlocks so many exciting planning opportunities for families. I think it's maybe the best philanthropic vehicle.
It's the best.
This is a great moment for America, I think.
When these billionaires want to gift their stock, they usually want to see some sort of impacts or something they want to do, or they want someone to hold their stock and not be able to sell it. Now, that hasn't happened yet, but if they can, that's the plan, is to be able to set these things up so that they can gift their stock. Yeah. And there's a forced period where you have to hold it for 18 years. That's a great philanthropic vehicle.
Well, I saw one. Gwen Shotwell, the president of SpaceX, is putting a bunch of her shares in Trump accounts, and you can actually do it by zip codes you want to impact. So, if you want to provide, funds to kids who aren't going to get, their parents funding their 529 accounts and their UTMAs and a trust fund, this is such a cool vehicle. But what I think is kind of the first step is really thinking through, like, as a family, how should you take advantage of this? So I've written now 3 blogs on this. I've got a white paper coming out. And I think as a firm, we've built what I would call the ultimate Trump account strategy. So I'm happy to get into that, Chris. But, let
me start, before we get into those details, let's start with the basics where I can add some value.
Go for it.
I like the app. The design looks nice. It's based on Robinhood. This is a recurring thing.
It's an incredible app. Like, they have the animations, like funding a piggy bank. Like, it's fun, you know?
It looks good.
They've got good projections. Hey, at age 18, how much money will you have? At age 60, what will it have?
Compliance has a field day with this, but I think I can do this without reviewing the investment in the portfolio, because they don't like that. They chose the S&P 500 fund that we use. Mm-hmm. So I think we can say we like it.
Compliance may or may not like that, but I think it was the right
fund.
pick. You know, originally they were talking about you'd be able to buy individual U.S.-based companies. I think that would have been a mistake. I think this is the right approach to just, one, keep it simple. You know, I think this is going to scale significantly, and I think they got it right. And the biggest objection I've heard to Trump accounts is people hate the name. You know, people that are not supporters of the president, or they really don't like him putting his own, you know, golden Trump name on this. I would just call it then Section 530A accounts.
Invest America. Yeah. They're going to change. The name will get changed eventually.
Yeah. The technical name is Section 530A accounts. And use that name if that helps you feel better. But take advantage of this for your family, because it is really harnessing the power of compounding and getting it started at birth. And that's a good thing for all Americans.
You said it's a great account. What is the best order that you've seen for financial planners?
Yep. So the stereotypical order you do for a kid is you start with a custodial Roth IRA account. The Roth is the most beautiful account structure that exists. Now, the problem with that is, I don't know about you, but my 3-year-old and my 1-year-old don't have earned income that make them eligible for a Roth IRA. So
I've tried.
Put them to work, Chris. So that's typically not available to people. That is the best thing to start with. Then you have the 529 plan for college. Those are great because you get a state income deduction in most states, like Missouri does. But some states, there's no state income tax deduction, and you can only move, you know, say you don't spend it all in college, you can only take $35,000 and get it into an IRA. So it's not like a great long. 35 is better than nothing. But
it depends on your goals. If your goal is to fund college tuition or tuition for your family, great. But we've talked to a few people recently, that's not their goal. They didn't want to do that, even though I thought the structure was better than the Trump
Most
account.
families want their kids to go to college. The 529 is still the best vehicle for that. Yep. But I think next, then you kind of have the ultimate showdown between the UTMA account, you know, which is a taxable normal investment account, like a brokerage account or a trust account. You know, so you have capital gains and dividends and all of that along the way.
And you could make changes because you have control over the investments.
And you can spend it before retirement, which there's a lot of nice flexibility there. But I think when we've done our analysis on this, the Trump account might win significantly if the goal is long-term, like wealth building for your kids in their retirement, which I think they're going to need when you look at Social Security and U.S. debt and demographics and all that. So I'm calling it the ultimate Trump account strategy. And what you do is you make sure $5,000 a year gets in your kid's Trump account. So ideally you get that first $1,000 straight from the government, the seed capital. If they were born last year,
taxpayer funded. That's the knock on the structure, is the taxpayers paying for new people born between 2025 and the next 3 years?
And I think through the end of 2028. They might extend that into the future. I think that'd be a good thing.
I bet they try to find a backer to fund that rather than the taxpayer.
I think that would be a good thing, and I think there's the backers to do it, so it's not just taxpayer money. Well said. But you start with $1,000, and then you can do monthly, weekly, contributions to this account. Maybe you want to just make your annual contribution when the market's down every year. That's probably what I'm going to do. Employers can do up to $2,500 per employee, so that would be divided among all their kids. That's what I've done with mine. I made the initial contribution for my 2 children, and then I've got the monthly just set up. Dollar cost averaging in is always best, and remove the decision making. But this is the strategy. So you do $5,000 per year into your Trump account, stops at age 18. I don't know about you, but my earned income was very little between ages 18 and 22 while I was an undergrad. So what we're going to do for our clients is convert it to Roth over those 4 years. So not a one-time Roth conversion with a bigger tax bill, spread it over 4 years, but end up, they graduate college, they've got a beautiful Roth IRA funded, and if you assume a 10% rate of return on the S&P 500 over the long run, at age 60, this is going to be a little over $14 million. Now, that's just a pure model. right? That's not how the market's going to work perfectly. But $14 million versus the UTMA after-tax amount, which was a little over $9 million. So if the goal is that long-term funding for your kid's retirement and that nest egg, the Trump account wins. And that's the work we're going to do with every family, whether it's your grandkids or your kids. We want to be a part of that conversation and spread the good news on this, because I think it's the winning approach.
This is the news since the last Fed meeting that we talked about, which the interesting part to me is just how many people, come on, the talking heads that you like to reference, talk about these new task forces. This was announced at the last Fed meeting. Is we want to have some change, but we want to create these task forces to come up with proposals to do the change by the end of the year.
Yep.
Now, the skeptic and where Aaron would be having a field day with this would be whenever the government rolls out task forces, it's because they want to avoid something and kick the can down the road and forget about it.
I would love to lead one of these task forces. I would just make the 2-year treasury the Fed funds rate and call it a day. But I think what was interesting, I listened to all of Warsh's opening remarks in front of Congress, and a few things stood out to me. It was, one, regime change. This is not the same Fed as what we're used to. I think these different teams and committees he's setting up to look at all the policies with fresh eyes, he really wants to put his stamp on the Fed, and he went out of his way to mention specific Fed errors. Like, he went back to 2020 and said that was an error. And I think what also surprised me, I was kind of expecting them to say, maybe inflation target is going to be closer to 3%. He said, no, we're absolutely rock solid committed to 2%. That's not changing.
Well, let's go through these committees, and because they have a framework targeting committee, and when you want to, let's build up to it. There's 5 of them. The communications, we already referenced this earlier. Communications, the idea the Fed talks too much. So you brought on 3 guys, and their view, shockingly, when you look at them, is the Fed talks too much. Stop all the talking.
Well, when the governors are contradicting each other on CNBC and different conferences,
it's a bad look.
It's a bad look, and it's confusing.
I'm not concerned with that at all. It adds a little more volatility to the actual changes, but it stops them to being tied to what they previously said. That's a good thing. We can move past communication. The balance sheet is the concerning one. This is basically the liquidity in the market from them buying bonds. And they brought together some people who really think that the balance sheet is probably too big. So they're going to probably come with a proposal of how to shrink the balance sheet, which would be pulling liquidity out of the market. That's, out of all of this, probably the risk to markets. The next one was data. We're using data that is lagged. We're using lots of variables that are assumed and not actual real.
They're past due on this change.
This is great. Yeah. Bringing in former Walmart CEO who has access to a lot of high-speed data. So that great idea. That's only going to be a positive. My favorite one, this is the one you would have probably want to throw your hat in for, was the Productivity and Jobs Committee, where they brought in Mark Andreessen, venture capitalist. What do you think he's going to think? Productivity is going to be a huge boom and probably lowers interest rates.
Yep.
And they brought
huge deflationary force of AI.
And we already referenced Microsoft's seat-based pricing. They brought in someone from Microsoft who is probably going to have this view that AI is not going to lay off a lot of people that would kill his business on.
Well, so far the evidence is that AI is not leading to more layoffs.
And the evidence is on their side.
Yeah.
So I think
now Anthropic CEO Dario is, every time he needs to raise funds, is saying it's going to take all the jobs and it's all powerful, and he's trying to hype it up. But that has not shown up in the data. Like, the famous one is radiologists.
Yeah.
All of a sudden everyone's worried we're not going to need radiologists. Well, guess what? There's more radiologists today than before all that technology came out, and they're better paid.
And so that committee is gonna have the view that we're entering a boom. You probably don't need to focus too much on raising interest rates. You're probably fine where you are. That's our view.
Yeah.
Like, I'd like to be on that committee.
And I like that Warsh acknowledged the problems in the housing market that the current rate environment's creating. Like, you think about guys like mortgage lenders, realtors, people trying to buy their first home. This has been a disaster area that the Fed has really left unaddressed.
That's what's in these meetings going forward. If they raise rates, you're going to see probably both sides get frustrated with them, because this is now Trump's guy. So the Democrats are going to say there's a housing affordability issue. You're raising rates into it. That doesn't make any sense. And if it adds, the market can handle 1 to 2 rate increases. So don't think I'm saying that that's a problem. The history is when rates start to change, they usually don't go 1 or 2. You're raising rates, you're going to raise rates 7, 8 times, not 1 or 2. 7 or 8 times from here, that's a problem for the market. I don't think it's going to happen. 1 or 2 is just pulling back some of the cuts from a year ago. We'll be fine. I don't think it needs to happen. But if they're really serious about the final task force that you mentioned, inflation targeting, brought on 3 guys who all believe in the strict 2% target. That's what they're going to say.
Yeah.
But I think the previous task force might be able to convince them, hey, this will play out on its own. As long as we're trending towards that 2% and rates are stuck here at 3.5% to 3.75 in the range, it's going to be okay.
Yeah. Personally, I think Warsh at the Fed chair level, it's an improvement over Powell. I'm optimistic. I think he is the right man for the moment. I think he wants to get us back to 2%. Like, it seems like that's their first goal right now. It's going to be very interesting, the speed and just how aggressive he gets to get there.
Well, he's bought himself some time with these task forces. This gives him, they're going to return their findings by the end of the year. So you can easily just say, if inflation keeps trending down, hey, I want to see this through, which is what they should do, and decide how they're going to approach this in 27.
Well, do you want to wrap up with our company spotlight, Chris?
Let's make it quick. Robinhood, we already mentioned it throughout the show multiple times. They're not making money on the Trump accounts. That's going to be a loss leader. But if they're getting people in their ecosystem, that's going to be a good thing from them. And they've done it. The app looks fantastic. And the simple thesis is just increased activity. Robinhood used to be, still is, a big, crypto's important to them, and so is options trading. Well, with these new IPOs, options trading goes up. Crypto's that's the wild card.
Crypto's pretty beat up right now.
That's the wild card. That was when we looked at it and we're charting it and looking at the fundamentals. And the market's going to continue to think you're going to keep trending down with crypto. So that was the headwind to the stock. What we thought, with peak rates, what we think might be peak rates and peak hawkishness being built into the market, if that changes, we're going to see a rally in some of those assets, gold and Bitcoin, and the rest of the crypto market is really a coin toss now because people have moved on from crypto to prediction markets, which is our next benefit or potential risk to Robinhood. And that is, it's a great way for them to make money. It's tough for the user. The user using prediction markets, they think they have some control. And then instead of sizing it 1 to 2% like a stock, they might go put 50% of their account.
I can't stand that we call it predicting. Let's call it what it is. It's gambling, and the house always wins. You go to Las Vegas and you see those buildings, you know who's making the money here. But I think one thing I'm excited about Robinhood, their demographic tailwinds are exceptional, better than anyone else in the financial services space. And 2, this stream of IPOs coming is getting the retail consumer interested in markets again. I mean, I don't know about you, but I'm hearing a lot of people ask me more and more questions outside the office about the stock market again. So I think it's the right entry point with crypto being so beat up. I don't think you want to buy Robinhood while crypto's at its all-time highs. I think it's a compelling story. The company leadership is interesting. Vlad, he took a beating in the GameStop scandal when, in those days they allowed people to sell, but the buy button on their app stopped working. And I think there's a lot of retail investors that have not forgiven him. But it's a beautiful app and it's a great experience. I mean,
they're professionalizing now. That's another part of the market that they can hit. Are they ever going to have people like us put client money there in the next 5 years? Not branded Robinhood.
Yeah, and they're coming for the RIA market. They want firms like us to join their platform.
Higher fee products coming too through. They have some subscription and more alternative investments, which is a cash cow for the custodians that are holding alternative investments. Very simple. Not a lot of trades happen. It's all inflows and sticky business. Those are good tailwinds for the stock.
But I think about Robinhood is our day's version of Edward Jones. So Edward Jones brought access to the stock market to millions of Americans in small and rural America. Robinhood is doing the same thing in a frictionless app for the millennials and Gen Z and Gen Alpha coming. And I think when you look over the long term, it's hard not to get excited about that overall story.
Thanks for joining us this month. Let us know if you liked our new co-host, and we will be back a month from now. Thank you.
Thank you.